Kurv, ETF research, exploring the monthly paying income strategies for retirement portfolio. So welcome back to the channel. I'm Doug, the retirement guy with the monthly ETFs. Today we're digging deeper into the Kurv investment ahead funds. You've probably heard of some of these. You probably haven't seen all of them, but Kurv has been really quietly out there developing some strong ETFs that I think we could really look at for retirement portfolios. One of the biggest things that they have is income first plan. And I want to see if it's really working. So today we're going to get into that. Before we do, we got to do a shout out to all of our Patreon supporters and our YouTube subscribers. You guys are phenomenal. We broke 6,000 already, and we're looking for as many more as we can get. Don't be afraid to hit that subscribe button, hit that bell notification. You don't want to miss a single video that we put out. All we're trying to do is help you grow your portfolio. Along with that, don't be afraid to sign up with that Patreon. It's free. There's so much information behind the scenes that you can get. It's all free. And if you want to support the channel, that's the best way of doing it. Let's get into today's video. Notice to all viewers, past performance does not guarantee future results. The information in this video is for educational and entertainment purposes only. If you need financial advice, always contact a financial advisor or professional before making those financial decisions. I am not a financial advisor. So let's meet Kurv Investment Management. Kurv Investment Ahead. You hear some of these portfolios out there. It's not the most popular one that go out, but it's always those unpopular ones that you always got to look underneath the mat and see, are these the ones producing solid incomes? So first off, Kurv Investment Management is relatively new and intact in the exchange traded landscape. They distinguish themselves by focusing on generating monthly income for investors. So they use an income first approach, which specializes in generating regular income through sophisticated option-based strategies rather than focusing on capital appreciation. Now, they're a competitive positioning. Their competitors are going to be the YieldMax, the Roundhill, the Granite shares, all the names that we're very familiar with in the income-focused ETF space. Now, the core strategies in their focus is that yield premium strategy. It uses options to generate cash flow rather than seeking capital appreciation. It creates synthetic long options through a combination of call and put options, and we'll cover that later. And it typically achieves 1 to 1.5 expense ratios on the funds. So that key difference that they're doing is that significant strategic strategy of payout dates across the funds, enabling investors to receive distributions almost every single week. So let's talk about the yield premium strategy, and I'll explain deeper what they do. The yield premium strategy, it's an option-based approach designed to generate monthly income by creating synthetic exposure to underlying assets. So number one is that synthetic long position. So what they go out and do, they systematically buy call options and sell put options, basically replicating the price movements without direct ownership. So what we're saying here is they're doing it without really buying anything. So they're doing the call option, they're buying the call options, and then they're immediately selling it as a put option. The premium that the income generation, the sales additional call options, typically 5 to 15% out of the money to collect premiums, which become a primary source of the monthly distributions. The cash collateral and interest, it holds cash and short-term fixed income collateral, earning additional interest to contribute to that monthly distributions. So how does that strategy really work? They're going out and they're making agreements to do buy calls. Immediately, they're turning around selling put options on the buy calls that they've had. That gives them a net position. The sell call premium they collect, the cash collateral that we talked about, money sitting on the sidelines, and then the monthly income all comes out to the very end. So what are the core trade-offs? Well, one is upside potential. You're not going to see the upside potential of the funds. What you're going to see is the income potential, potentially double-digit yields. So what you're really giving up here is most of the stock's upside potential, the full participation in stock appreciation, and long-term growth prospects. What you gain, though, is stepped cash flow. So you're getting payments both on put calls and cover calls, potential monthly income, and retain downside protection. So right now in today's times, the downside protection is huge. Getting that potential monthly income is, again, a very strong piece to it. So let's take a look at the full lineup of the ETFs that they have. On the single stock strategy, they have Apple, Amazon, Google, Microsoft, and Tesla. Other strategies that are out there is the technology titans, the Kurv Gold Enhanced Income, the Kurv Silver Enhanced, and then something that they just produced is the KYLD, which is the Kurv High Income. So now let's take a look at each one of them independently. So let's take a look at the performance trends and the NAV analysis of the AAPL, which is the Curve Yield Premium Strategy for Apple. So when we take a first look, their distribution rate 11.85%. They have SEC yield of 2.26%, and frequency is paying out monthly. So the key highlights is assets under management is $4.8 million. They have shares of over 200,000 shares outstanding, and their expense ratio is 0.99%. This program was introduced in October 27th of 2023. So we're just over 2 years old on the fund. So it has some track history of what they're able to do. When we look at the performance of it and you look at the bar chart, you will see that, yes, we had the April 2nd drop off. It's slowly coming back out, even with a fund that is not designed to capture the upside. They've done a fairly decent job. So they're down 6.78 year to date, primarily all from that April 2nd drop off. When we look at the overall performance, you got to look at everything. The inception, that's at 16.70. 1 year, they're at 11.66. Year to date, 4.17. And 1 month out, they're 9.70. Now, this does include all of their distributions added into it. And all of this information is the current information as of November 12th, 2025. So these things can change almost literally by the minute, by the hour, and so on. So right off the bat, I look at this and see, Apple giving us a 11.85% distribution. It's not too bad. And holding its own in no NAV erosion. So I'm pleased across the board with that one in my evaluation. And I always suggest everyone to do your own evaluation on funds. Let's look at the Amazon package that they offer. And when we look at this, you will see 19.22% distribution. When we look at the chart, again, drop off in April, it has slowly recovered back, and they're only down 2.56% year to date. Performance, this one again, 30% since inception, 22% in 1 year, 15.98% year to date, and 1 month up 11.71%. When we take a look at their highlights, they're at 13.42 million, 440,000 shares outstanding, a 0.99% expense ratio, and this one again came out October of 2023. So it's had a good 2-year run already on it. Now we'll take a look at the Curve Google package, 12.95 distribution rate and 2.43 in the 30-day yield. And now look at the chart though. This one, we didn't see the big drop off in April, and this thing is up 24.71%. Fairly strong growth rate off of a fund that's not designed for growth. We look at the bar chart, including your dividends, and those come in at 38% since inception, 45.96 in 1 year, and 42.46 year to date. Quite impressive numbers right there. We look at the highlights of it: $12.18 million on their assets, 330,000 shares outstanding, the 0.99 expense ratio, which is pretty common for this fund. And this one came out in October of 2023. So we take a look at the Microsoft package, and distribution on that one, 28.36%. We look at the chart below. Again, we do see that April drop off, but we see massive quickly recovery and growth up to 5.69% year to date. We look at the portfolio performance, and you're at 15.59 for inception, 18.56 year to date, for 1 year, and 17.7 year to date. This one here, 6.29 million under assets, 240,000 shares, the 0.99 expense rate, and this one came out on October 23rd. Then we get into the Netflix package, 19.39%. So right off the bat, my personal opinion and what I look at when I'm doing these type of investments, everything's been a solid double-digit performance. Everything's coming fairly strong with the 19%. We look here again at the bar chart. We do see a drop off in that April, which is expected. It recovered well, but didn't hold as long as it wanted to. It's only down 1.30%. And Netflix across the board has been this way. So it's following almost what the key underlying stock is doing. Performance-wise, 41% since inception, 22.59 for 1 year, and 16.20%, including your dividends. And they have 9.85 million under assets, 300,000 shares, and 0.99. This one came out October of 2023. And then their final one in the single stock category, and that's going to be the Tesla program, 22.96%. We look at the drop off. It's raised a little bit, hasn't really come out of the April tariff issue. It's down 20.37%. That is not NAV erosion. That is just a fund that does not gain well. We look at the performance, 33% year inception, 27.88, and then 7.39 year to date. $22 million in assets, 920,000 shares, and they're going to say expense rate 0.99 to 1% right in that category. And this one came out in October 23. So let's take a look at the sector side of it, the technology titans. And this is KQQQ is very much, you want to think of the Magnificent Seven. They do a lot of things above that. They do a lot of things, all technology. Distribution 17.7%. We look at the bar chart. We see the April drop off. We don't see the recovery that we've seen in other funds. They're down 20.37%. This is what I expect a lot from the Kurv, is that you don't see a lot of growth out of it because they're not designed that way. They're designed to generate income. We look at the performance across the board, 24.83% since inception, 22.60 1 year, 19.73 year to date. The fund, 22.59 million, 920,000 shares. Gives you that 1% basically expense ratio. And this one came out in July of 2024. So about a year, I'm going to throw a year and a half, just shy of a year and a half that it's been out. So a little bit of performance, some positive, negative performances across the board in that time frame. So let's talk about the KGLD, which is the Kurv Gold Enhanced Income Program. We've looked at this one before. It has a 12.37 distribution rate. It has $32 million under assets. They got 1.14 million shares outstanding. They have an expense ratio basically about 1%. Came out in July of 2025. Now, the neat thing about this one is they do a lot of stuff inside the gold enhanced income. They pretty much trade into another ETF to generate the calls and the put options. When we look at this one, since the start of July, it's just had a nice slow ride up, 17.63% growth. So doing a decent, you didn't see really much of a drop off until we got here into late October, early November, but it has stabilized. And so far, since inception, it's up 79.66%. So again, some really good number performance from them. And then we take a look at the silver package. And the silver package, again, is 18.34 million under assets and shares of 750,000, 1% expenses. This one came out September 29th. So this is like the newest kid on the block from them. We really only have a short, maybe 2 months total performance out of it. Already has some great performance of 106.14 since inception, 23.48% distribution numbers. Had a nice ride up to about the 15th, middle of October, and had it slow drop off, and it's recovering back up. Still 6.99% year-to-date growth. This gives you the enhance and gives you the opportunity to be in the gold. This gives you an opportunity to be in silver. So it's a lot of different funds that they offer that you can get into in the ETF. We look a lot at the assets under management because that tells you what the fund's doing. Is it growing? Do they have enough money to work with? And the nice thing about the Kurv program, they don't need a ton of money to do their swaps and do their option buying and selling across the board. So now we take a look at the total returns, which is your yield plus your year-to-date growth for a total return. And when I look at these, if you have to remember back when we first started, it said that we are really designed for yield and income generation, not for appreciation. So when I look at their yield, I'm impressed. When I look at their growth, it's about what you would expect. When you look at the total returns, you got to say some strong things of everyone but the KQQQ, the technology titan, has developed a strong total return. So, when you're looking at 30% growth rate or total return rates, those are some good numbers coming out of the Kurv packages. So I look at, say, Google, Microsoft, Netflix, the gold and the silver options are all definitely ones that I will definitely look at potentially putting them into my portfolio. So, total investor profile. The income-focused investor, the monthly cash flow priority is what this funds are designed for. The risk-return balance. It's a comfortable with option-based strategy risks and strategic thinking. Understand the portfolio positioning. The satellite positioning is what I personally fell in love with, and I like the idea. It's not a core holding. So what they're doing is they're not buying core material. What they're doing is they're using their net assets to buy the calls and immediately sell the puts. So they're not really putting money out. It's like they have the option on those calls and they're already selling the puts. It's an income booster what's doing it. So we also say these are not set and forget investments. You do have to stay focused on them. You do have to watch them, but they're not the volatility is not there as much as other funds. So the key risk factors. NAV erosion is always a big thing. Now we just went through all of those and really didn't see any NAV erosion on the offerings, on those ETFs. But NAV erosion is always one you got to worry about because of that capped upside. When it goes down, you're going to have a strong, hard time to bring it back up. The limited upside kind of works hand in hand right there. The limited upside, same thing works with that NAV erosion. The volatility impact. Income relies heavy on option premiums, which fluctuate in the market. Volatility or potential reducing the monthly distributions. So we don't want a lot of volatility of rocketing up and rocketing down numbers. What we like is that mediocre or that middle of the road volatility that you can trade the thing 2-3 times in the same day. Single stock risk, when you're putting your eggs into that one basket of an Apple or a Tesla, you have to really watch what's the company actually doing. Expense ratios, they're going to call them key factors. I've seen where now pretty much have to accept about 0.99 fees across the board. And, they're going to say short track history. 2 years into this, yes, you want to see 5 to 10 years on a lot of funds. But overall, 2 years, I think you can make a fairly decent judge out of it. At least I feel I can make that judge fairly comfortably. So my final assessment, I think these things are competitively marketplace positions. I personally like the funds. I don't take my advice. This is not advice. This is just Doug's opinion. I like the Kurv programs. I like the packages. I think it's definitely a lot better than the YieldMax packages. When we're going apple for apple with monthlies, Granite shares and Roundhill, they have some good things, but those guys are starting to focus more on the weeklies, and Kurv is really focusing on monthlies. The income boost category, I'm telling you guys, I think it's working. Personally, I think it's working. The double-digit income across the board on every fund, I didn't see anything that was out of whack. I didn't see anything that was terribly bad across the board. And when we look at that final sheet that had all of the total returns, I'm just telling you, I think Income Boosters is doing very well. And the future market potential, if the Kurv investment management continues to build a solid track record and manage those fees efficiently, they could be a significant player in 2026 for all of these funds. Tell me what you think. You got the same information I got. Do your research. Tell me what you think. Do you think these things are the strong ones for the future? Are they strong for a retirement program? Where are you at and how are it?
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.